Okay, acquisition method of accounting. 4 important stages that we need to understand. Whenever we are doing acquisition accounting, now having gone past the test saying this is a business combination, not an asset acquisition, the next stage is how will we account this now? 4 steps, 4 very, very fundamental things. First, identifying who is the acquirer. Second, acquisition date. What are the asset liabilities coming in? How will you measure them? And then finally, goodwill, or is it a gain, a bargain purchase? Let's look at each of them. So, for a business combination, one of the combining entities shall be identified as an acquirer. Now, before we get into this, why do you think, do you think this is really a challenge? Identifying who is an acquirer. Do we see this as a challenge, or is it straightforward? What does the group feel?
Straightforward.
Straightforward? Straightforward? I'll then skip this section. We'll go ahead. Anybody else? Any other thoughts?
Sometimes it could be challenging, let's say a small entity is acquiring a big one. So, I mean, who gets merged in whom?
Bang on.
Reverse merger.
So there are a lot of situations where transactions are structured in a way to achieve specific objectives. Classic case, reverse acquisitions. Right? A smaller company taking over a larger company. Correct. So again, why is it relevant to know who's the acquirer in these situations? Any idea? We talked about reverse acquisitions. Why is it relevant? Okay, so a smaller company is taking, that's an acquirer. So what's the big deal?
Fair valuation.
Any thoughts?
Fair valuation of the acquiree's assets.
Absolutely. Now, whose assets and liabilities will you fair value? So the legal acquirer is a small company. So will you fair value the assets liabilities of the bigger entity? That is the question. And we'll get into it in the reverse acquisition, but I just wanted to set the context why it can be important. So one of the combining entities shall be identified as the acquirer. So who is the acquirer? What are the guiding principles? The entity that obtains control of the acquiree is identified as an acquirer. And 110, that is the consolidation standard we'll cover in the next section. The guidance on control has to be looked at. Who is taking control? What is the meaning of control? If applying that consolidation guidance does not clearly indicate who is the acquirer, then following factors are looked at to say who is the acquirer. Acquirer is usually the entity that transfers cash or other assets or incurs liabilities. Again, you have to look at it holistically. One thing cannot get you anywhere. Acquirer is usually the entity that issues equity interest. Acquirer normally has the largest portion of the voting rights in the combined business. Okay? Acquirer will have the ability to elect or appoint or remove a majority of the members of a governing body. Right? Now let's look at this. Applicable when a smaller entity acquires a larger business, a larger company. Let's say a startup acquiring a Reliance Industries. Okay, a smaller company acquiring something like a big as a Reliance Industries. Example, A Limited, a big private company, wants to become a public entity but does not want to register its equity shares. In order to accomplish that, A Limited gets itself acquired by B Limited, a smaller public company. So it could be a variety of reasons the transaction gets structured. It could be for tax benefits, there are losses, so you do a reverse acquisition. So it could be a variety of ways, right? Now, if we had gone with this, A acquiring, A Limited issues equity shares to B. Private company, so legally, A is getting acquired into B. So legal acquirer, acquiree is A, because A is getting acquired. So legally it is that, but from an accounting sense, it will be the acquirer. Clear? Similarly, B, public company, which is a legal acquirer. Legally, if you look at, obviously B is acquiring A, right? But accounting deviates. From an accounting perspective, it will be the acquiree. Its assets and liabilities of B will get fair value, not of A. Hence, it is very important, this is one example. You could have certain other cases where two entities merge and a third is created. Now who's the acquirer? Whose assets to be fair value? The legal acquiree in substance is the acquirer. So it changes. So legally, if you are the acquirer, accounting you will be the acquiree in a reverse acquisition. The consolidated financials prepared following a reverse acquisition will be like this. It will be issued in the name of the legal acquiree, that is B in the earlier case, which was the smaller entity. It will be issued in the name of B, but described in the notes as a continuation of the financial statements of the legal subsidiary. So A was the accounting acquirer. So all assets, liabilities which are going to come in the financials will be of A at book values, added up at fair values of B, right? Because the name is B, but the financials and comparatives will be all of A, with fair value of assets getting added into the asset pool. Net assets of legal subsidiary at pre-combination carrying amounts, because the legal subsidiary is actually accounting acquirer, right? The A. Net assets of legal parent, which is the accounting acquiree, are stated at fair values. Comparative information is that of legal subsidiary, which is again the acquirer. So again the comparative you will give of A. Because for accounting purposes, we are saying it is A who's acquiring B. Legally B may be acquiring it. But from an accounting, it is all reverse. Okay. Then if you look at this example again, where a new entity is formed to effect business combination between two or more entities, say B and C, Ind As 103 identifies two distinct scenarios. Now, new company issues equity instruments in exchange for equity instruments for B and C. Either B or C should be identified as the acquirer, right? New company transfers cash in exchange of equity instruments in B and C. New company may be the acquirer. Now, so we need to really evaluate what is the purpose of this transaction. Is it just for a manner of structuring it that it has been done for entity A and B? Instead of merging together, they are saying we will open a new company where we will transfer all our assets and liabilities, which is new company, right? So then who becomes the acquirer in this situation? We'll look at an example on this. X and Y are two existing entities carrying on businesses independently. The two entities decide to combine the business through a new entity Z. Z issues equity shares in itself in the proportion of 2/3 to the equity shareholders of X and 1/3 to the equity shareholders of Y. Now, should Z be regarded as an acquirer, or who should be regarded as an acquirer in this situation? So who is issuing equity shares? Z, right? So if we go back to the principle we talked about, acquirer is usually the entity that transfers cash or other assets. Acquirer is usually the entity that issues equity interest. Now, there are various guiding principles. Okay, now how do we look at this? So how many would believe that Z is the acquirer in this case? Any thoughts? Anyone who believes Z is the acquirer? Anyone who believes X is the acquirer? Okay. So I'm assuming others believe that Y is the acquirer, because there cannot be a fourth one now. Right? Okay, you're not sure. Oh, that's a good category. Okay. So, you mentioned X is the acquirer. Why would you say that?
Because going back to the previous example, principle, Z cannot be the acquirer as per the rule, and it is giving the major part of its share to X, that is 2/3. So it is assumed that 2/3 has more weightage on the Y entity. So it
okay.
Acquired.
So you're saying to that extent X will have a higher weightage.
Yeah.
Largest
Okay.
portion of voting right.
So largest portion, but it also says who issues equity shares, right?
Here control, it seems that since the largest power of voting, so that's why control
Okay.
is
So you're saying because of the voting shares. Anybody who feels Z is the acquirer? No one. Okay. So Z cannot be, right? Z is just an empty shell. It is just issuing equity shares. As he rightly said, who is going to control this combined business? The 2/3, again, one can infer that the 2/3 voting rights will give power to X to run the business in the combined basis. Hence, X becomes the acquirer, Y will be the acquiree, asset liabilities of Y get fair value, right? Had you identified Z as the acquirer, think about it, what would have happened? X and Y's asset liabilities would have got fair value, and the answer would have been completely different, right? Hence, we said who is the acquirer becomes very relevant in some cases, that you need to be very clear who is acquiring who. Okay, there is a second important concept and very, very relevant from an Indian context, acquisition date. Okay, why again this is important? It is the date when the assets and liabilities get fair valued. It is that date when the valuation gets determined. Okay, so it's very important that we get this correct, identify this correctly, because at times, again in an Indian context, it could be very different. Exactly when the control transferred is the date when acquisition accounting can happen. Generally the date on which acquirer legally transfers consideration, acquires assets, assumes liabilities, will normally be the closing date. However, the acquirer might obtain control on a date that is either earlier or later than the closing date as per the agreement. The acquisition date precedes the closing date if a written agreement provides that the acquirer obtains control of the acquiree on a date before the closing date, right? Date on which control is acquired by the acquirer is the acquisition date. What points we need to think through or ponder or have a look at before closing out what is the acquisition date? Important points to consider. Is the agreement subject to substantive preconditions on the acquisition date? The acquisition date will be the date the last of those conditions is satisfied. Date when acquirer commences direction of operation of financial policies. Date when majority of board of directors are appointed. Date when the flow of economic benefit changes. Date of clearance by a competition authority, if any. So very important, and we'll discuss this with an example when we get into this. Okay, let's look at this. So company A has signed a purchase agreement with company B on July 1, 2010. Purchase agreement was filed with the High Court for approval on Jan 1, 2001. Purchase agreement provided that subject to High Court approval of the agreement, any profit loss arising out of operations of B from July will belong to A. Purchase agreement provides that the management of B will run from July 2000 as a trustees of A. Purchase agreement also provides that the purchase consideration payable by A to B will be based on B's net assets as of July and as determined by an independent valuer. The High Court approves the transaction on 25th of March 2001 and is filed with the ROC immediately. A is preparing consolidated financials for the year ended 31st March 2001. So in the consolidated financials, should company B, should CFS include company B from 1st July, 1st January or from 25th March? Again, a very, very straightforward transaction in an Indian context. You know, we would see this. A court effective date would come in, the court would grant clearance, effective dates coming in. In this situation, from what point of time should we start consolidating the acquiring? Okay, we seem to have some different views. So how many believe 1st July? Fair enough, 1st July. So we have a few people, 1st July. Anybody, how many believe it is January 2001? Anyone? No one. How many believe 25th of March? Okay, we seem to be in minority. 1, 2, 3. Okay. Any other thoughts on this? Undecided? Okay. So, you know, you said 25th of March. Why would you say that?
Because High Court approval, as it is mentioned, that date of clearance are completely approved.
Okay. But the control, when is the control transferred? Okay, let's look at here. Why do you say it's July?
All the assets and
Sorry?
all the assets and all these things transferred.
From 25th July? Economic benefits? Sorry? Management control started on 25th July? Okay. So, we are saying, sir, any thoughts? What do you think?
I'll go with
High Court approved it.
Okay, you'll go with High Court approval date. Okay.
It says that PA provides that subject to High Court approval of the agreement, loss will then be there.
Okay.
Is this not considered as a precondition for the agreement? And in your previous line, you said that after the last precondition is satisfied, something.
Correct. So,
It also talks about the date, like we also provide the purchase concession payable to by A to B will be based on cash value
correct.
on July.
On July.
Before the
Okay.
closing date. So that can also be taken as.
So that is why we would say July is a this thing, right?
There are other reasons for it.
Okay, that's another argument for that. So as we all see, we are divided here, right? It's pretty, at times again, challenging. What is the acquisition date? Friends, here, and this is very relevant for us, okay? In this condition, if High Court approval is substantive, as if it can change the color of the game versus just a form filing, right? Then the control actually transfers when the High Court approves this. So the question we have to ask, is High Court able to, can change the equation, can change anything in the acquisition that we are doing? It may allow, it may not allow. But if we believe it is more of a form filing formality, it's like a president signing the budget, which is already done, right? If that's a formality we are saying, if High Court is going to be a formality, then acquisition date becomes July. But if you see in an Indian context, High Court approval is very essential. It can actually change. And we've seen, acquisitions not going through.